Hi, I'm Brooke Thackeray with Horizons ETFs. Thank you for joining me today. Today I'd like to take a look at what's going on in the markets. I'd like to use the Horizons Seasonal Rotation ETF, ticker symbol HAC. Its weekly commentary is part of the basis of this analysis, as well as look at the broad market and different sectors of the stock market. Let's jump right in by taking a look at the S&P 500. Here you can see that we did see this little bit of a pullback for the S&P 500, which is down almost 1% last week, but that was off all-time highs. Not really a big concern from a technical perspective. We did see the RSI continue to diverge from the S&P 500. So we've seen the RSI moving down as the S&P 500 has been moving up. That doesn't mean the S&P 500 is about to have a big correction. It just means that the market's becoming a little bit susceptible to some sort of softening overall. Last week was really a lot to do with the Federal Reserve meeting on Wednesday. And this one was a little bit different because it dealt with the SLR, or the supplementary leverage ratio calculation that banks use to determine how much credit they can extend towards consumers and also businesses as well. As the pandemic unfolded last spring, the Federal Reserve announced that banks could exempt their treasuries as part of the SLR calculation so that banks could extend more credit towards households and businesses. Now, that exemption was set to expire on March 31st, and investors were getting a little bit concerned coming into the Wednesday meeting that this exemption may not be extended. And if we take a look at the price action for the S&P 500 last week, and this is Wednesday here, despite Powell not extending that exemption, the S&P 500 was positive on the day, as Powell was generally more dovish than expected. Thursday was the down day for the markets, and Friday was slightly down with a lot of price movements as well. But really, if you want to take a look at really what was going on too, helping to drive the markets, was the interest rates. And if this is the closing price of the 10-year yield for the U.S. Treasury note, you can see on Wednesday that we did see that uptick in the yield for the 10-year. And on Thursday, we saw that sharp rally. And on Friday, once again, we saw that rally as well extended, as investors really were unsure of what was going to happen with the SLR, selling bonds in the marketplace, which was also raising interest rates. So last week, we saw the 10-year yield touch 1.75%. Which is a post-pandemic high as well. Last week, as far as the markets go, you'd expect in a rising rate environment, part of that reflationary trade, a lot of the cyclical sectors to perform quite well. But last week, if we take a look here, the industrial sector, using the ETF XLI, did manage to outperform the S&P 500, but it wasn't really a substantial improvement in price. And if we take a look at the price pattern chart for XLI relative to the S&P 500, so this second panel here, we can see here that we've seen a lot of chop back and forth here for the performance of the industrial sector relative to the S&P 500, despite rising rates. This is a little bit of a sign that we might starting to see some weakness for some of the reflationary trade taking place. And as well for the we're seeing the same thing for the material sector here as well versus the S&P 500. You're starting to see that actually really flatten out and chop back and forth. Now, in a reflationary trade, you would expect both of these sectors to actually perform quite well. If we take a look as well, so here's the material sector last week, which performed equal to about the S&P 500. And let me just try and pull that back because I didn't do a very good circle there. I'm blocking out the next one I'm going to talk about, and that was the banks last week, and this is the Canadian banks. We did see them actually perform quite well last week based upon rising rates. So a little bit of a divergence here with banks actually performing quite well, but some of the other cyclical sectors are not performing well. The big news last week was the energy sector, which actually had a very bad week. We saw that big, huge downdraft on Thursday as investors took note, and they said, well, perhaps what we've seen here is the the energy sector move up too fast and too strong, and there was some profit taking place. Now, this is important because the energy sector has a strong seasonal period from February 25th to May 9th, on average over the long term. Sometimes that seasonal period can start early, and sometimes it can start late, and sometimes not at all. But when it starts early, sometimes it can finish up its trade early. And if we take a look at the energy sector here, and I'm using the ETF in Canada, HXE. You can see here, and this is relative to the TSX Composite, S&P TSX Composite. You can see the rally started in October, or I should say November, performed strongly into January. And then really we saw a little bit of a pullback. And we saw the latest run start in late January. So we saw this latest run start earlier than normal, and we're starting to see this downturn relative to the overall market as well. Something to watch out for. The energy sector can still perform well, particularly in the month of April, but we're starting to see a little bit of weakness for the sector itself. It may not persist, but something to at least pay attention to overall. As well, if we and oh, by the way, so last week we did see HAC trim back its position in the energy sector earlier in the week as HAC started to see some weakness there. As well, HAC did take a small position in the consumer staples sector as well. We're starting to see a shift overall for the different sectors of the market that could possibly show that the defensive sectors are actually starting to participate in this rally. They've been neglected for so long. We've seen growth really perform well at the beginning of the pandemic with the work from home stocks, and we saw the value stocks, the cyclical stocks actually really perform well. And the defensive stocks have been totally underperforming as investors have had no interest in them. But the strong seasonal period for the defensive sectors such as consumer staples is coming up. And if interest rates do actually start to pull back, we could actually see a shift into some of the defensive sectors. Now, on a seasonal basis, interest rates or inflation expectations tend to taper off at this time. We tend to see inflation expectations increase in January, February into March, and then we start to see them level off here a little bit and then start to turn down in May. So if we do see inflation expectations pull back a little bit, interest rates even pull back a little bit or start to stabilize here, we could start to see a shift away from some of the cyclical sectors in the marketplace. Now, technology could actually benefit from that in the growth sector as well, because investors could shift back to that. But you would also probably see an increased interest in some of the defensive sectors in the marketplace. So we'll have to watch what's going to happen over the next few weeks, see what's happening with interest rates, which is really driving the disparity in performance between the different sectors in the market. And if investors are moving back to some of the growth sectors or into the defensive sectors, or both as well. So something to watch out for over the next few weeks. Thank you very much for joining me today.